Welcome to vTalkInsight, Market Drivers Daily for February 11th, 2026. AI investment, jobless growth, and widening gaps between winners and losers are all colliding today, and markets are struggling to price that mix. Let's start with how the AI build-out is evolving, and what that means for risk across equities and credit. Over the past few sessions, we have been talking about AI less as a blanket growth story and more as a source of separation between winners and laggards. That pattern is deepening as the AI cycle moves firmly into a heavy build-out phase. On the real economy side, chip makers are signaling extraordinary demand. One leading foundry saw its January revenues leap about 37% from a year earlier, and in response, it has lifted this year's capital spending plan to roughly $56 billion, about a quarter higher than previously indicated. At the same time, hyperscale platforms have raised their 2025 Capex guidance by close to 30%, and aggregate AI and data center spending across the largest technology firms is now estimated in the hundreds of billions, with scenarios pointing towards several $1 trillion over the next 5 years. What stands out today is how easily credit markets are absorbing this investment wave. Investment-grade tech bond issuance this year is expected to exceed $300 billion, driven largely by AI infrastructure financing. Hyperscalers alone are projected to raise between $250 and $400 billion in debt, and we are already seeing marquee deals to back that up. One large platform recently printed $20 billion of bonds, including rare 100-year paper in sterling and Swiss franc, and drew well over $100 billion of orders. Despite the prospect of around $3 trillion in AI-related Capex over 5 years, spreads in high-quality tech credit remain tight. That tells us investors are still comfortable underwriting the AI build-out, even as equity markets get more discriminating about which business models can actually turn this spending into durable earnings. That discrimination is clearest in how markets are treating AI disruption across sectors. Software names that look vulnerable to new AI tools, including data and sales platforms, have suffered sharp drawdowns as investors question whether their franchises can keep up. Insurance and legal services are another flashpoint. U.S. brokers have faced persistent negative sentiment on fears that AI could compress fees and margins, while European insurers have come under pressure as investors reassess valuations in light of new technology risks. Travel is also in focus. Surveys show consumers see travel as a top use case for AI, and new AI-driven travel assistants may threaten traditional online travel agencies if those platforms fail to become the default interface for trip planning. Even within banking, AI is now a core part strategy. Some large institutions are pushing aggressive cost reduction targets while rolling out AI tools in trading and cards businesses, with the aim of boosting returns and freeing capital for shareholder distributions. At the macro level, AI investment is clearly helping GDP, but is not delivering broad labor market gains. In the United States, around 85% of recent growth is now attributed to AI-related Capex and high-end consumption, with limited spillover to wages for the median worker. Analysts note that current productivity gains still owe more to post-pandemic efficiency improvements than to AI itself. Yet there is growing conviction that as these systems mature, they could lift the long-term growth trend above the roughly 2% pace of the past decade. The inflation impact is more nuanced. Large-scale AI, Capex, and automation can raise productivity and ease some price pressures, but they can also create hot spots in power, specialized labor, and components, pushing up costs in certain niches. Energy is emerging as a key bottleneck. The AI build-out depends on abundant and reliable power, and regulatory and permitting constraints are increasingly cited as hard limits unless policy becomes more supportive. Geopolitically, AI is now framed as a core element of national security. A dedicated technology and AI advisory council has been set up around major security forums, underscoring that access to compute and data is viewed not just as an economic issue, but as a strategic one. For markets, the key implication is that AI creates both concentrated upside and asymmetric downside. Equity investors can participate in outsized gains for a small group of platforms and infrastructure providers, but credit holders mainly face downside if disruption undermines cash flows. Recent analysis highlights that in a severe AI disruption scenario, leveraged loan default rates could jump by around 6 to 7 percentage points, and private credit defaults could rise by up to 9 percentage points. By contrast, the upside for lenders is capped at par plus coupons. There's also a growing recognition that AI-driven earnings growth is likely to concentrate in large technology firms, with only modest uplift expected for broader corporate profits in the near term. Some market moves around disruption may already have overshot. In areas such as insurance and legal services, the immediate impact of AI is probably years away. So the recent sell first, ask questions later reaction may gradually fade as investors reassess fundamentals. Overall, the AI narrative is evolving from a one-way growth engine to a complex capital cycle with power, labor, and credit risks attached. As we turn to the broader growth picture, the question is how much of the current global acceleration really depends on this AI infrastructure wave. The growth backdrop remains surprisingly firm, but the composition of that growth is changing. In the United States, real GDP is projected to run above 3%, with some quarters potentially printing above 4% as both fiscal and monetary policy tilt more supportive. However, much of this expansion is being driven by capital expenditure and government spending rather than broad-based job creation. AI-related data center buildouts alone are estimated in the $650 billion range and rising, and they are adding meaningful stimulus to sectors such as energy, materials, industrials, and real estate. Consumer data still looks solid. January spending rose around 5% year-on-year across income cohorts, with discretionary areas like travel seeing renewed strength, suggesting employment remains resilient and confidence intact despite some disappointing headline retail sales numbers. Outside the U.S., growth is becoming more synchronized, even if the pace varies by region. As central banks in many economies move toward rate cuts, credit activity is picking up and hard data are improving, pointing toward a more coordinated global recovery. Emerging markets stand to benefit from a stable to slightly weaker dollar environment, even if no major downtrend in the dollar is expected. Markets with strong AI linkages, such as Korea, are seen as particularly well-positioned for 2025, helped by supportive policy frameworks and integration into the global AI supply chain. China's outlook, while still complex, has improved tactically compared with a year ago. A more constructive policy tone and a greater focus on AI-related industries are contributing to a perception of better opportunity, at least over the near term. In Europe, recent German GDP and manufacturing order data have beaten expectations, yet equity flows remain subdued. That leaves room for potential catch-up should the macro surprises persist. Policy settings are a crucial part of the growth story. In the UK, the central bank expects inflation to return to its 2% target in the second half of the year, which would open the door to interest rate cuts. High-frequency indicators, such as purchasing managers' surveys and January retail sales, already show tentative signs of improving productivity and momentum. If sustained, that could help shift sentiment toward the UK, though political uncertainty is still pushing some investors to look elsewhere in Europe. There are also growing calls for more ambitious UK growth policies, including clearer infrastructure plans and housing reform. Early steps, such as new rail commitments in the north of England, are seen as positive but not yet sufficient to transform potential growth. In Japan, a recent political shift has handed the leadership a stronger mandate for reforms. Proposals to reallocate spending toward younger cohorts, reduce subsidies for unproductive firms, and leverage the country's manufacturing base could underpin a supply-side transformation and attract additional foreign capital. This mix of AI, Capex, and policy easing is producing a broadening set of growth beneficiaries. European equities have pushed to record highs, with leadership rotating away from U.S. mega-cap technology toward more cyclical sectors, such as basic resources. Financials are leaning into the environment as well. One major UK bank has laid out a plan to reach at least a 14% return on equity by 2028 and to return more than £15 billion of capital, underpinned by ongoing cost discipline and increased use of AI to automate processes. In healthcare, a large pharmaceuticals group remains on track toward an $80 billion revenue ambition by 2030, supported by a sizable pipeline of late-stage projects and numerous key readouts expected this year. Beyond listed markets, African infrastructure has delivered around 8 to 13% annual returns with very low default rates over the past decade. That track record is drawing attention from investors seeking both yield and exposure to structural growth. Travel also illustrates the uneven but improving picture. Global cross-border activity at a leading hotel group has moved beyond 2019 levels, even though inbound tourism to the United States remains below pre-pandemic peaks. The counterpoint is that this growth upswing is far from inclusive. U.S. economic gains are increasingly concentrated among large technology firms and high-income consumers, while many small businesses and first-time homebuyers face ongoing financial strain. Real wage growth is close to zero, and productivity gains appear to be accruing mainly to capital, not labor. AI-driven Capex is boosting profits and GDP, but it is not yet generating broad-based job creation or a meaningful improvement in economic sentiment. Globally, youth unemployment is rising, particularly in trade and manufacturing sectors, even as healthcare labor markets remain tight. That fragmentation raises the risk of political backlash if the perception takes hold that the AI and infrastructure boom benefits only a narrow slice of the population. On the policy side, stronger than expected U.S. growth alongside persistent inflation could keep the Federal Reserve in a cautious, data-dependent, and possibly hawkish stance, despite political rhetoric calling for extremely high growth targets. In short, the world is moving into a phase of faster but more uneven growth, heavily powered by Capex rather than jobs. That sets the stage for the third key theme: growing divergence across markets and within asset classes. Market divergence remains the defining pattern beneath relatively calm index levels. Volatility has been pronounced in recent weeks, but major equity benchmarks show only modest net moves year to date. At the same time, there's a notable disconnect between strong equity performance and resilient long-dated bonds. Global fixed income has rallied despite news that would typically push yields higher, such as political uncertainty and optimistic growth forecasts. In the United States, long-term Treasury yields remain elevated compared with past easing cycles, while the dollar is weaker than traditional relationships might suggest given robust growth and expectations of rate cuts. That mix points to some confusion about the true global growth outlook and the durability of the current risk rally. Regionally, leadership has shifted away from the familiar mega-cap U.S. technology names. European equities continue to print fresh highs, with rotation towards sectors like basic resources and away from the largest U.S. growth stocks. The move into value and non-U.S. markets is widely seen as fundamentally justified, especially as the earnings growth gap between the U.S. and Europe is expected to narrow in the second half of the year. Quality sectors in Europe, including staples and discretionary, are viewed as undervalued and potentially more defensive if markets come under stress. Yet there are warnings that parts of this rotation may already be stretched. Indiscriminate selling in software and persistent underperformance of small caps hint that the trade could be nearing exhaustion, even if the longer-term case for diversification away from U.S. concentration remains intact. Within Europe, performance dispersion is high. Bank stocks have rallied over the past year, but expectations have risen as well, and German bank share prices now look closely tied to the pace of domestic GDP upgrades and loan demand in the second half. AI is a major force behind this divergence. Market leadership within technology increasingly depends on the ability to balance massive Capex with credible earnings growth. Companies that can deliver both, such as leading chip manufacturers riding the AI demand surge, are being rewarded, while others announcing high spending without clear monetization are punished. Insurance is a good example of how this plays out across sectors. European insurance names have come under pressure as investors worry about high valuations and new technology risks, and one major player has recently traded lower on the day despite a stable broader market. More broadly, analysts expect AI to drive consolidation in banking by 2030, with fewer institutions and greater dispersion between winners and losers as operational efficiency and digital capabilities become decisive. Outside traditional assets, crypto markets reveal another kind of divergence. Trading in the largest coin is now dominated by institutional flows, while retail participation remains subdued after past drawdowns, and shallow liquidity is amplifying price swings. Credit markets face their own AI-related challenges. The rapid increase in tech sector Capex is leading to a significant wave of debt issuance, and while high-grade spreads remain contained, analysts highlight a meaningful tail risk for leveraged loans and private credit if disruption undermines cash flows. Because most corporate bonds refinance at par, credit portfolios have limited upside from AI success, but remain fully exposed to downside from business model failure. That asymmetry contrasts with equities, where investors can capture more of the potential upside from a handful of AI winners. Some investors looking to align with the AI buildout are focusing on sectors that already manage heavy Capex cycles and use hybrid financing structures, such as utilities, which may offer more predictable credit characteristics than highly levered technology issuers. Meanwhile, U.S. tech companies are increasingly tapping European debt markets, further integrating transatlantic credit cycles and nudging European managers to look beyond domestic sovereign and corporate exposure. One important question is how much of this divergence reflects fundamentals versus positioning. Recent continuity in credit spreads and safe haven demand for long-dated European bonds suggests that, so far, markets still interpret the volatility spike as driven more by flows and supply than by a clear growth scare. At the same time, the bifurcation in the real economy is hard to ignore. Digital sectors tied to AI are driving most of the growth, while parts of the real economy, including small businesses and lower-income consumers, are under strain. Looking ahead, key watch points include whether non-U.S. and value leadership can persist, whether small caps and software stabilize, and how any emerging stress in leveraged loans or private credit is managed. Political developments, from UK uncertainty to debates over U.S. growth targets and central bank leadership, add another layer of potential divergence between markets and the underlying economies. Bringing all of this together, the picture is of resilient headline indices masking a market that is increasingly about precise selection rather than broad beta. To sum up, AI is now a full-scale capital cycle, financed by highly receptive credit markets, but concentrating growth and earnings in a narrow group of platforms. Global activity is accelerating and broadening beyond the U.S., yet much of the expansion is Capex-heavy and job-light, raising political and market sensitivities. Across assets, the real story is divergence between equities and bonds, between regions, and within sectors as AI disruption, valuation gaps, and policy risks reshape leadership. Investors are watching how these tensions resolve through earnings, defaults, and policy signals over the coming quarters. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.